how an individual can do a proper financial planning. And yes, when anyone discusses about financial planning, the first and foremost step is to ensure he has a proper life cover. When we discuss about life cover or life insurance, one thing which should come into your mind is term insurance plan, right? So any life insurance plan, or when you're discussing about insurance for self means considering a pure term insurance is the best option. Nowadays, with the kind of a products or the variants we have various products in the market. So in term insurance, we have return of premium. Without return of premium, we have even insurance coupled with investment products, right? There are some traditional plans, there are some ULIPs, unit linked insurance plan. So there are different variants of products. So I always strongly feel when you're buying an insurance, it should be at an arm's length with investment, right? So don't club insurance with investment. If you are doing insurance, it should be a pure term insurance. And if you are doing investments, it can be invested into any financial instruments. It can be invested into stocks, it can be invested into mutual funds, it can be invested into any financial instruments, be it like your ETF, right? Be it like your Bs, be it like your bonds, any debt mutual funds, right? But don't club both of them. Now, in term insurance, majority of the members who have been investing or who have been taking a insurance plan will have a confusion. Sir, should I prefer term insurance with return of premium or without return of premium? The basic fact here is term insurance means you pay a small premium and you get a very good cover. Like if you are getting a life cover or sum assured of 1 crore, let us say, right? Your premium amount would be around 0.1 or 0.2 percentage of that, which means let's say you're taking a 1 crore life cover, a term insurance, right? Your premium amount should be around 10,000 to 20,000 like that. So that premium means without return of premium. Let's say an individual is aged 35 years and he's taking a 30 years plan. So till up to 65 years, if anything happens to him, his or her nominee will be getting 1 crore life cover. And if he is surviving till 65 years, as it is a without return of premium, he will not be getting any insurance premiums, whatever he has paid for the entire 35 years, right? For the entire 35 years. I repeat, a person aged 35 years has taken a life cover of 1 crore till his age of 65 years, right? If anything happens during that period, his or her nominee will get the entire 1 crore as a sum assured. And whatever he has paid till 65th year or the next 30 years, whatever he has paid from 35 years to 65 years of age, if he is surviving till 65 years, he will not be getting any insurance premiums what he has paid. Now comes the most interesting part. There are many companies and they come out with a plan, you get return of premium. So the same example, 35 years old, next 30 years he has taken a policy till his age of 65, and if he is surviving till 65, this return of premium policy will give him whatever is the premiums he has paid till 65 years. And anything happens in the between, he'll get his life cover of 1 crore. Now everyone would feel, yes, sir, this return of premium is the best option. Now there is the catch, right? What is the catch? When you are going for without return of premium, where you are not getting whatever premiums you have paid every year, the premium, if it is, let's say, like around 13,000 is the yearly premium you are paying to get 1 crore life cover. For return of premium, you have to pay 2 times or 3 times more than the normal premium, which means you will be paying 30,000 premium every year to get that life cover. So as an investor, as a person who is investing into the stock market, or as an investor who knows the power of compounding, or who knows the calculation of future value, this would not be an ideal situation, right? So what we will do, the same discussion, let me keep it in an Excel sheet and let's do a small math, right? Why I say do not club insurance with investment, right? So I'll be taking couple of examples here, right? So let me take the product, and here we are discussing about term insurance. First, I'll be taking without ROP, return of premium, and next I'll be taking term insurance with return of premium. Okay, so here what is the difference when you are paying the premium amount, right? Every year you have to pay a premium amount to get that life cover. If here it is, let's say for example 13,000 per year, normally where you are getting back your amount, return of premium, the amount will be more, at least like double or triple it will be. So here you have to pay 30,000 per year as the yearly premium to get the life cover of 1 crore, right? To get a life cover of 1 crore. So what are we discussing here? We are discussing about an individual. It can be a male or female, aged 35 years, and he is looking at a tenure to take insurance for up to 35 years, which means he will be covered from 35 years to 65 years age, he will be covered. Okay, and the life cover, what we are discussing here is for rupees 1 CR, right? 1 crore life cover we are discussing. So in both of these scenarios, till his age of 65 or within this 30 years period, if anything happens to him, his nominee or her nominee will be getting 1 crore life cover. But the difference is, are you paying 13,000 per year every year, and if nothing happens to you during this 30 years period, you forego the entire premium what you have paid, right? So this is how much without return of premium, right? Without return of premium, so 13,000 is what you are paying. So now with return of premium means whatever you have paid, which is 30,000 per year for the next 30 years, right? So how much is the amount you have paid, which is nothing but your 30 years into 30,000 is what you are getting back, right? So here observe the difference. When this person reaches 65 years age, he will be getting 9 lakhs into his account. Whatever premium he has paid, he'll be getting it back. Now, does an insurance company work in order to make loss? Definitely no, right? It should be a win-win situation, or the insurance company should be benefited. So now the major part which majority of the people miss is, in a normal term insurance, which is the traditional product, right? This is the traditional product where you are paying 13,000, instead you are paying 30,000 here. So there is a difference of almost 17,000. So let's do a math, right? Let's do a small math. So what I will do, what is the difference in premium? The difference in premium is your 30,000 minus 13,000, which is 17,000. Okay, and what is the a tenure? How many years you have been paying this extra amount, you have been paying for 30 years. And what I will do, let's suppose for an example, I have been paying every year 13,000 per year to get a life cover of 1 crore to a term insurance company without return of premium. And the difference of this 17,000, I'm investing into equity market, right? Be it into a simple mutual fund where I get an interest of 10% per annum, right? I'm taking a very nominal kind of interest considering I get over, I'm investing for 30 years. Every year, 17,000. Now let's look at future value calculation, right? Future value. So what do you do? For future value calculation is equal to FV interest rate. What is the interest rate? I've been taking 10% per year, and N per number of years, which is 30 years, and PMT is every year what is the amount I've been investing, what is the payment, right? Payment. So I'll be selecting 17,000, right? So I have selected minus. In future value calculation, if your inputs are in minus, you get the output as positive, right? So, or any amount you are investing, money flowing from your pocket into the investment should be represented with minus. Money coming into your pocket will be as positive, right? So 17,000 I'm investing, money is going out of my pocket, minus. Future value I'll get in the future, so that will come as positive, okay? And present value, is there any lump sum amount I'm investing? No, zero. And every year at the beginning of the period, I'll be investing, right? If I close the bracket, so if you look here, any person, right, who has a basic understanding about the math, or any person who has a basic understanding about compounding, right? Compounding. You see the difference here. Person A, who has selected without return of premium and has been investing into the market for the 30 years. Person B, who is investing more, 13,000 plus the remaining 17, almost 30,000 is investing, right? So this person B gets 9 lakhs at the end of the 65th year. But this person, by investing into a pure term insurance without return of premium and investing separately into the market, he gets a value of 30 lakhs 76,038, right? So this is the difference, right? So this is the difference between person A and person B, right? So person A, he will be getting 1 crore life cover and this 30 lakhs. Person B, yes, he is also getting 1 crore life cover and 9 lakhs at the end of the tenure. So it's not that the insurance company is doing anything wonderful or has given you an excellent product. So what I wanted to bring to your notice, or what I wanted you to think about is, right? So if psychologically you feel, sir, I've been investing 13,000 and when I am turning 65 years, whatever I have paid, this 13,000 per year, I'm losing the entire amount. That is why I've opted return of premium, right? So you have to understand you are paying a difference in premium, the higher amount. So that amount company uses for investments into the products, and whatever the returns they get, they pass on to you at the end of the tenure. So you going to return of premium, consider that, or take a pure term insurance plan, pay 13,000 per year, and parallelly, at least if you invest the same premium into a investment for that entire 30 years period, right? Even if I take this, the same term insurance, 13,000 premium, right? So whatever you have paid, you'll be getting it double or triple at the end of the 30th year, right? So I hope everyone understood what is that we are discussing here. And also, let me give you a quick comparison, right? Let me give you a quick comparison. So whatever we have discussed here, you'll understand the entire summary of it. So if you look here, a pure term insurance is what I would highly suggest, where you get a pure life cover. Don't mix it with any investments, right? But in term insurance with return of premium is something that you get your policy premiums, whatever you have paid at the end of the tenure, right? So here returns wise, not at all applicable. And in return of premium, you get whatever you have paid, the premium amounts, right? A premium wise, in a term plan, you are paying 0.1 percentage or 0.2 percentage as the premium amount. So 1 crore cover, 0.1 percentage means 10,000 or 20,000, right? Within that bracket, it will be there. As the age increases, your premium amount increase. So the earlier you take, the better it is, right? Here, the premium amount would normally be 2 to 3 times higher than the pure term insurance, right? And on the taxation wise, yes, you have your benefits of 80C taxation or even section 1010D, which means when you're claiming the amount, when you're claiming your sum assured, you get tax-free amount there, right? And third part, traditional plans. Few people invest in protection, life cover plus savings. So whatever pay the premium amount, you get a life cover and you will be getting some lump sum amount at the ending also. But the same math, whatever we have done for term insurance and without return of premium, just take the difference, premium difference. I'll give you an example. Let's say for 1 crore life cover, a term insurance is 13,000. And here in a traditional plan, for the same 1 crore life cover, I'm sure the premium would be very high, would be around 55,000, 60,000 and even more, because you are getting some amount back also. So just look at what is the final amount. And if you just take the difference amount and apply your future value calculation and even 10%, whatever amount you get in a traditional plan, by just keeping in an investment product, you get minimum 3 to 4 times more, right? That's why I always say, do not combine your insurance with investment, right? Do not combine your insurance with investment. Keep it separate, right? Keep it separate. So here in a plan where protection and savings is included, you almost pay a 10% of the coverage amount as the premiums, right? As the premiums. So the final gist is insurance and investment, keep it at an arm's length. And when I speak about insurance, ensure you do a term insurance, preferably return of premium is good, right? Return of premium is good. Okay, good. So I hope everyone had a clarity about one of the most topic which many of you would have not thought about it, right? Like return of premium or without return of premium. Okay, so let me know how many of you have loved this discussion. Let me know below.